What would happen if you discovered that every economic crisis wasn't an accident, but a meticulously architected design? That while millions lost their homes, their jobs, and their life savings, a select few not only survived but multiplied their fortunes exponentially? You're about to dive into one of the best-kept secrets of modern financial history. A truth that headlines never told. A system designed not to fail, but to fail exactly as planned. It was 2006. The American economy pulsed with a seemingly endless force. The real estate market hit new records every quarter. Wall Street celebrated with astronomical bonuses. The music played loud, and nobody wanted to believe the party would end. In American suburbs, ordinary families realized the dream of homeownership with mortgages that seemed miraculously affordable. Credit flowed like water in a thirsty desert. People bought homes with zero down payment. They renovated kitchens with second mortgages, financed luxury cars with the accumulated equity of properties that kept appreciating. But in the upper floors of Manhattan skyscrapers and offices away from public view, a very different reality was taking shape. Investment bankers created financial instruments so complex that few could understand them. CDOs, NBSs, swaps, synthetic derivatives, an alphabet soup that masked the truth. They were packaging time bombs and selling them as safe investments. And what few know is that at that very moment, many of these banks were already betting against the very products they sold to clients. Goldman Sachs, for example, sold toxic CDOs to pension funds while secretly taking massive positions betting on the fall of these same assets. Think about this for a moment. It's as if a car manufacturer sold knowingly defective vehicles while buying stock in funeral homes. But what makes all this even more disturbing is that it wasn't a mistake. It wasn't incompetence. It was by design. In 2004, the Federal Reserve, under Alan Greenspan's command, began raising interest rates from 1% to 5.25% in just 2 years, an increase of 425%. He knew what would happen to adjustable rate mortgages when this increase hit the market. Every economist knew. When rates soared, millions of Americans saw their payments double, triple overnight. The American dream transformed into a nightmare. Foreclosures exploded. Entire neighborhoods transformed into ghost towns. Lives destroyed, families shattered. And while this happened, a massive wealth transfer occurred silently. The same institutions that created the crisis now bought properties for pennies on the dollar. Private equity funds like Blackstone acquired tens of thousands of homes from evicted families, transforming American trauma into an unprecedented investment opportunity. But have you ever wondered why nobody saw this coming? In truth, many did. They were silenced, marginalized, ridiculed. In 2005, Raghuram Rajan, chief economist at the IMF, presented a paper warning about the systemic risks of new financial instruments. He was practically driven out by Larry Summers, former Treasury Secretary, who called him a Luddite and technically incompetent. Brooksley Born, chair of the Commodity Futures Trading Commission, tried to regulate derivatives in 1998. She was blocked by Greenspan, Summers, and Robert Rubin. The derivatives market remained in the shadows, growing to more than $600 trillion, almost 10 times the world GDP. If you're feeling a shiver down your spine right now, wait until you discover what comes next. This is just the beginning of the web connecting financial crises to the greatest wealth transfer in modern history. Subscribe now to not miss any revelation. When the bubble finally burst in 2008, the world watched Lehman Brothers collapse as if it were an isolated event, a tragic accident, the result of the unbridled greed of a few. But what if Lehman's collapse was actually a calculated sacrifice, a public spectacle to justify what would come next? In the 72 hours following Lehman's bankruptcy, something unprecedented occurred. The U.S. Treasury and Federal Reserve implemented the largest financial bailout in history. $700 billion officially, trillions in reality. But here's the central question: where did that money go? The same banks that created the crisis received massive capital injections. The same executives who sold toxic securities kept their million-dollar bonuses. The same institutions that bet against the housing market now received unlimited funds at near-zero interest rates. And the average American received a stimulus check for $600. This is the true face of the liquidity trap, not just an economic concept, but a deliberate strategy. When central banks flood the system with money in response to a crisis, that liquidity rarely reaches the real economy. Instead, it creates asset bubbles that disproportionately benefit those who already own capital. Think about the stock market after 2008. Between March 2009 and December 2019, the S&P 500 rose more than 400%, one of the biggest bull markets in history. Meanwhile, the average wage, adjusted for inflation, practically stagnated. Central banks knew this. Policymakers understood this dynamic. It wasn't a side effect, it was the goal. But the true genius of the system is how it sustains itself through the illusion of complexity. The language of modern economics was deliberately constructed to seem impenetrable to the ordinary citizen. Quantitative easing, open market operations, emergency credit facilities, words designed to obscure a simple truth. Money being created out of thin air and channeled to the world's most powerful institutions. Do you believe it's coincidence that after each crisis, inequality increases dramatically? That the share of wealth controlled by the richest 1% has grown steadily since the 80s, precisely when neoliberal policies of financial deregulation gained strength? In 1980, the richest 1% of Americans held about 10% of national wealth. Today, they control more than 40%. And this trend accelerated dramatically after each bailout. The story we've been told is that this is an inevitable result of free market capitalism. The reality is very different. There's nothing free about a market where losers are selectively saved, where risks are socialized while profits remain privatized. And here we reach the fundamental question few dare to ask. What if the system isn't broken? What if it's working exactly as designed? In 2009, at the height of the crisis, while millions lost their homes, Wall Street banks reported record profits. Goldman Sachs paid $16 billion in bonuses that year. J.P. Morgan Chase, $29.9 billion. At the same time, more than 8 million Americans lost their jobs. More than 10 million lost their homes. The average wealth of American families fell 28.5%. The largest drop since the Great Depression. Wealth transfer. Not wealth destruction. Transfer. And the scariest part? This wasn't an isolated event. It's a cycle that repeats, each time on a larger scale. The savings and loan crisis in the 80s, the dot-com crash in 2000, the global financial crisis of 2008, and now we look to the next iteration, potentially more devastating than all the previous ones. Because each crisis not only transfers wealth, it consolidates power. Each solution concentrates more authority in the hands of unelected and uncontested institutions. The Federal Reserve now holds powers that would be unimaginable before 2008. It can buy corporate bonds, inject trillions into the economy, essentially pick winners and losers without any meaningful democratic oversight. Would you trust your future to a system deliberately built to transfer your wealth into the hands of a few every 8 to 10 years? Bubbles aren't accidents in modern financial capitalism. They're essential features. Instruments of wealth transfer disguised as market failures. And as we look to the future, the signs of a new bubble are everywhere. The stock market reaching records while the real economy suffers. Unicorn companies valued in the billions without ever having generated profit. Cryptocurrencies, NFTs, SPACs. New vehicles for the same dynamics. New technology, same trap. The real question isn't whether the next crisis will come. It's when. And more importantly, who will pay the price again? Power isn't just the ability to act. It's the ability to define reality. To establish the boundaries of what can be discussed, questioned, imagined. The true triumph of the financial elite wasn't just amassing unimaginable wealth, but convincing the world that there is no alternative to the system they designed. Think about what happened after the 2008 crisis. Was there any significant structural reform? Did any banker go to prison? Was any too big to fail institution broken up? No. Instead, they grew. They became even bigger, even more powerful, even more entrenched. The 5 largest American banks now control assets equivalent to 60% of the U.S. GDP, up from 30% before the crisis. An unprecedented concentration of economic power in modern history. And meanwhile, the official narrative remains untouched. The idea that markets self-regulate, that inequality is the necessary price of growth, that the next wave of financial innovation will finally bring prosperity for all. But history tells a different truth. Each wave of financial innovation, from junk bonds in the 80s to derivatives in the 90s, from CDOs in the 2000s to cryptocurrencies today, served primarily to create new mechanisms for value extraction, new ways to transfer wealth from many to few. The question you must be asking now is there a way out? Is there a way to escape the next trap? Perhaps the first step is recognition. Understanding that what we're experiencing aren't random failures in a basically sound system, but deliberate features of a fundamentally extractive system. Look at history and you'll notice a consistent pattern. After each crisis, after each massive wealth transfer, resistance movements emerge. After 1929 came the New Deal reforms. After the 2008 crisis, the Occupy Wall Street movement emerged. These moments represent rare opportunities, windows where the veil lifts momentarily, where ordinary people glimpse the true nature of the system that shapes their lives. Knowledge is the first form of resistance. Understanding how liquidity traps work, how crises are manufactured, how wealth is systematically transferred. This knowledge is power. A power that financial elites have worked tirelessly to keep obscured. Think for a moment, why isn't financial education mandatory in schools? Why do terms like derivatives and repo markets remain mysterious to most people? Why do central banks operate with a level of opacity that would be unacceptable in any other public institution? Because public ignorance isn't a flaw in the system, it's a necessity for its functioning. But we're at a unique moment in history. The digital age, with all its flaws, has also given us unprecedented access to information. The ability to decode, to learn, to understand how the system that governs our economic lives really works. And perhaps therein lies the greatest threat to the status quo. Not in government regulation, which was captured long ago by the same interests it should control. Not in traditional institutions, which have become gears in the machine, but in the emerging collective consciousness, in the growing understanding that another world is possible. Because the real trap isn't just financial, it's cognitive. It's the belief that the current system, with all its dysfunctions and inequalities, represents the only possible path. That alternatives are utopian, unrealistic, or dangerous. But history repeatedly shows us that economic systems are human creations. They can be redesigned, reimagined, rebuilt to serve many instead of few. What would you do if you realized the next crisis is already being architected? That the same mechanisms, just with different names, are being positioned to execute the next great wealth transfer? Would you become a passive spectator again? Or would you find ways to protect yourself, your family, your community? If this video has opened your eyes to the hidden gears controlling the global financial system, prepare for what we'll reveal in the next episode. Because the liquidity trap is just the beginning. The tip of the iceberg of a system designed to extract, not empower. To concentrate, not distribute. The real question isn't whether you can completely escape this system. It's whether you can learn to navigate it with open eyes. Whether you can develop the awareness and tools to resist the next planned extraction of wealth. Because the greatest wealth transfer in history isn't in the past. It's being prepared now, before our eyes, for those who know where to look. See you in the next episode of Vault of Secrets, where we'll dive even deeper into the web connecting central banks, shadow governments, and the true power behind the financial throne. The final question I leave with you, when the next collapse comes, which side of the wealth transfer will you be on?